Thank you for attending this conference this year. It's a great conference. I am Justin Hartz with LDG Development. LDG builds safe, high-quality, affordable housing for Texans. LDG is looking forward to working together today with the stakeholders we've seen throughout the day this morning to meet the goal in solving this housing disparity that we're currently experiencing. Equitable access to credit is integral to building the American's dreams for all. Without access to credit and the ability to secure a mortgage, home ownership, education, and business opportunities remain a distant dream for many Americans. This session will bring together experts who will explore this issue and will be moderated by Michelle Dickerson. Dickerson is a distinguished professor who holds the Arthur L. Muller Chair in Bankruptcy Law and practices at the University of Texas at Austin. She's the author of Homeownership in America's Financial Underclass, Flawed Premises, Broken Promises, New Prescriptions, and is currently working on her second book, The Neglected Middle Class. I'd like to introduce Michelle Dickerson.
I am delighted to be participating in this summit today on credit, debt, and intergenerational wealth. As you know from the introduction, it's both my research interest. It also happens to be a course I'm teaching this spring. So for me, I'm learning as much as I think I'll be giving this morning. I'd love it if the three panelists could actually join me on the stage. I'm going to give a little bit of an overview to sort of set the stage in terms of where we are. Rolf helped out a lot because a lot of what I thought I was going to say, I don't have to because he's already sort of teed it up for us. So before I present the panelists, and they are now seated in the order that they will present, but I'll tell you their names in just a few moments. I want to remind us sort of why we are where we are in the city of Austin with respect to who has access to credit and who does not have access to low-cost credit. So in a few moments, you'll hear lots of discussion, and hopefully you all will have questions about sort of the problems that poor and marginalized communities, and in particular communities of color in the city of Austin face when they try to get access to credit. For a host of reasons, and we'll talk a little bit, I think, about sort of financial education, credit education, but you'll notice in certain communities in the city of Austin, when you drive around, that certain types of lending institutions aren't there. So you'll see traditional bankers in certain places, and then you'll see non-traditional financial services providers, which is the way I refer to payday lenders, pawn shop, car title lenders. Because of this economic segregation, in certain communities, it's basically a desert in terms of low-cost credit opportunities. So as you listen to our presenters, I want you to keep in mind, I love the phrase that Rolf used, we did this on purpose. We ended up where we are in terms of where credit is available on purpose. And he started, I think, in 1990. I'll go back to World War I, right? So when we think of redlining, and you look at which communities were able to get access to low-cost, affordable, and low-risk mortgages, it wasn't communities of color, not Black, Latino communities. Those communities paid more. And when you look now, we'll see a few maps in a few moments, when you look now at where it is still hard to get access to low-cost and affordable credit, redlining played a big role in that. So as we are discussing solutions, and I know that the panelists will come up, will propose some solutions, and if not, I'm going to ask them questions so that they will tee up some solutions. Keep in mind that the government played a role in creating some of the problems that we are now struggling with. So as Roy said this morning, we can't nonprofit our way out of this. The government has to play a role in helping to solve the problems because, again, to come back to what Rolf said, we did this on purpose. So the program has longer bios on our three speakers, so I'm just going to state their names and their organization, and their, so basically name, rank, and serial number, right? Their names and their organization, their titles, and I will announce them in the order in which they will present. So first up, we will have Garrett Groves, who is the Economic Opportunity Program Director at the Center for Public Policy Priorities. After Garrett, Joyce McDonald, who is the Executive Director for Framework Community Development Corporation. And then Ann Badur, who is the State Director with the Fair Financial Services Project of Texas Appleseed. They'll present about 5 minutes. We'll then have a conversation. And please, again, if you have questions, pass them and they'll sort of come up to me. She'll come around and pick them up, and then she'll get them to me, and I'll get through as many as I can. With that, Garrett.
Well, thank you very much, everybody. If you're not familiar with the Center for Public Policy Priorities, we're a statewide policy and data workshop. Think of us in some ways as the Urban Institute that we get right here in Texas. But we also advocate on behalf of low and moderate income Texans. So we spend some of our time at the state capitol having some of those discussions that we heard our mayor and judge speak about this morning. And we're increasingly doing local work, city to state, policy work in particular. So we're very interested in how policy and policy change affects these challenges. But after this discussion this morning, I'm really sitting with the challenge of the fact that I've always thought of myself living in Austin, Texas, as living in one of the most progressive cities in the country. And we pride ourselves that way here in the city. And yet, by many measures, we are one, if not one of the most economically segregated cities in the country. And it's hard to square those two realities. How can we be progressively leading the way on many issues and at the same time be demonstrating such huge economic segregation? So I wanted to bring a few maps, if I can. One is to highlight some of the great work that the Urban Institute's doing. Not only all the information that Ralph shared with us, they also just launched a new interactive map specifically on debt in America. And what's really available there is county-wide information across the country on the share of Americans who have debt in collections. So this isn't just the number of us that are accessing credit for things that we need to do, like mortgages on homes and access to education. This is the debt that now has been delinquent, is now being collected upon and hurting our credit scores. So if you just Google debt in America, Urban Institute, you'll come up to this map. Again, it's interactive. You can look across these pieces. And some of the first information that we have on medical debt. How many of you know the percentage of debt and collections that comes from medical debt in this country? I was stunned to realize that it's over half of all the debt that's in collections comes from medical debt, which brings us back to the interconnectedness of debt, access, and healthcare. Here you can see what's great about what the Urban Institute's done is they've broken out this data by race and ethnicity to the extent that they could. So you have estimates by non-white, white, and all across these different indicators. You also see the geographic patterns that we already spoke about this morning. Another project that we're doing at the Center for Public Policy Priorities is that we are able to do economic opportunity assessment analyses and looking at data across cities in Texas. And what I'm able to foreshadow here is a report that's going to come out in Dallas, where we're looking specifically at credit score. Now, this is a project that I've done in partnership and actually with most of the work being done by the Federal Reserve Bank here in Dallas. Our Federal Reserve Bank has great access to credit data. They're able to look at information and really drill down at a sub-county level in a way that we haven't seen before. So this is a much longer and extensive report that will be coming out later this month or next month. But what you're seeing on the map here is that we have the same geographic diversity actually divide by credit score. So the darker purple color here is higher credit scores, which are on the north part of Dallas. On the top right, it's smaller, but we'll share these slides after. You will see that that's also the wealthiest part of Dallas, and that wealth and credit scores correlate, which many of us wouldn't be surprised by. South Dallas is where poverty is more concentrated. It's also where credit scores are lower. And then on the bottom right, you'll have access to a map that shows race and ethnicity in the city. And if you look across all three of those maps, you see very clearly the same patterns. Now, part of this report is from a piece that we're doing for the Communities Foundation of Texas in Dallas, and this report has maps like this that look across many, many variables. So if we do a map of educational attainment, it'll look very nearly like this. We do a map of commuting times, how long it takes you to get to work, and it looks like this. So if you are in an area of lower income, you're less likely to have a higher level of education, you're less likely to be able to commute to work, you're going to have harder access getting credit, you're less likely to own a home. All of these indicators layer on top of each other and create challenges that really we think, or I think more about as a escalator, except it's moving down and you're trying to walk up this escalator. The lower your income, the more difficult it is in our society to get access to these things. If you get to a certain point, however, that escalator turns and starts going up with you. So if you get to a point in this country where you have higher educational attainment, you're going to do better and you're going to excel faster. Same thing with credit scores. One last piece I'll foreshadow on the credit data. In Dallas County, we've been able to look at this information and see that access to credit varies according to your credit score. So if you have higher credit scores, you have more access to mortgage loans. And we know this. If you have a subprime credit score, your access goes down. We do not see those same trends for student debt. In fact, some of our highest amounts of student debt are owned by those that have a subprime credit score, because you have to go to school and you have to go to college. So I'm happy to revisit a lot of this data. There's a lot of different pieces we'll touch on, but I'll pass it to my colleagues here so we can get the conversation started.
Good morning, everyone. Can y'all hear me? My name is Joyce McDonald. I'm the Executive Director and co-founder of Frameworks Community Development Corporation. It's a pleasure to be here. My piece is dealing more with, on the ground, what prepares anybody for a mortgage lending product and where they stand concerning understanding the dynamics of what it takes to get approved for a mortgage, and at the same time purchasing affordable and purchasing in a way that's sustainable and purchasing in a way that they're not overstated with credit once they close on their home. And so one of the things that we identified during the education piece is that most people don't have formal education about credit. And that's where the divide occurs that we have been able to identify. It's the access to the education about credit. Most folks have entered into the credit arena and have never had any formal experience about credit, thereby not knowing that some of their activity is showing up on their credit report and how that's impacting. They don't discover that until it's too late, until they're ready to use the credit. So one of the important factors that we determine is how do we bring this non-educated individual into a space of education for appropriate utilization of credit in preparation for being able to acquire a purchased home. And so we found this report, or I did receive this report from a website concerning Experian. So it basically shows the top states with the lowest scores, and this is an Experian report, the states that have the highest credit. So that data really doesn't tell us anything because, you know, we don't know why some states perform better with others. That really is meaningless information. Okay, so what is more meaningful is where should someone start getting education before they, at what stage of their lives, at what stage in someone's life should they start getting access to education about credit, given the fact that we live in a credit-driven society. And we find that the education is the barrier. Because even if there's a predatory lender or a predatory program or product, you have no idea how to ban or protect yourself from that activity if you don't have education about credit, education about interest rates, education about APRs, what goes into APR, what goes into cost of credit, how to structure your credit, how to use credit to raise scores as opposed to massing debt. Obviously, income plays a role in accessing credit because when lenders, for instance, dealing with mortgages, they look at what's called the debt to income or back-end ratio. And if you have a lot of debt and large monthly minimum payments, your debt to income ratio versus the percentage of your gross monthly income that can be used for mortgage financing is distorted. So the other side of the coin is affordable purchase housing. Where does it exist? How do we make purchase housing affordable? Where do you have to buy to be able to make a purchase? And then the other component is as property values are going up because there's such a pressure on the demand for housing because of population growth, can you keep up with the cost of owning a home? Because it's not just the purchase, but it's the sustainability and the costs that go along with sustaining, the maintenance, the home warranty, property taxes, interest, homeowner's insurance. So these are the factors that we have to look at. It's not just acquiring, but it's the ability to sustain and keep up with the cost of living. We wanted to kind of show you some of the factors that go into credit scores when we provide our services as a housing counseling agency. We try to put it in perspective for the borrower. We don't know all the formulas that go into the logarithm, but we do know that these 5 factors, if you master these 5 factors, you're going to win in the credit game. How much do you owe? New credit, how much new credit are you consistently applying for? The length of your credit history, your credit mix, and your payment history. Once we put this in perspective for someone who may not be doing well with credit and give them a strategy on how to get this mix in concert with one another, they're going to come back and their scores are actually improving by 100 points. We're seeing folks come back through a follow-up if they're not mortgage ready and they use this strategy. They're going to come back and have more savings, better credit mix, improve credit scores, and then be eligible for mortgage financing. And then finally, this is our, based on our 9902, which is a report that we have to submit to HUD concerning our performance for homebuyer education and counseling. We're finding that our client mix, anyone who makes 80% to 100% of the MFI, that's a large population of folks that's coming to us in that mix. So we are seeing a combination of very low income to folks that make over 100% MFI, and that's median family income for the Austin Round Rock metropolitan statistical area. And then this is our kind of mix on our racial demographic. So we're seeing folks pretty much all over the map, and we're seeing the pattern of not having great credit from someone who has low income to someone who has very high income. So it's education. Thank you.
Thanks. My name is Ann Badur, and I'm with Texas Appleseed. We're a public interest law center that works on social and economic justice issues in Texas. And I'm going to, oops. There we go. This is my little slide that if I had greater graphic design skills, it would look a little better. But the main point that I want to make with this, and going back to the conversation about how these are structural, the divide that we have right now is structural. It's something based on policy. And our goal is to start thinking about how we break down that structural divide. And right now, I was struck by Joyce's use of the appropriate utilization of credit. Well, for a lot of communities, the appropriate utilization of credit is just not available. And you see that wall, and once people get stuck in the alternative financial services sector, which is a nice way of saying payday loans, that range from 2 to 500% APR, rent to own, finance companies, auto title loans, and a lot of very creative mortgage products that take advantage of people's desire and aspiration to own a home only to leave them defrauded or with nothing in the end. I mean, these are the kinds of products that families often feel like are their only choice. And so a lot of the work that I've been doing is focused on small dollar lending, payday and auto title lending in Texas because it's particularly egregious. But really what we need to think about is how do we start breaking holes in that brick wall so that people who are in this alternative financial services cycle have mechanisms to get out of there. And I think that there are some deliberate policy things we can do. Just to give you some additional statistics, just not to over-statistic you, but the Urban Institute has been doing some great local level research. And they did a profile in Austin on credit scores, looking at credit scores in white and non-white neighborhoods. And in white neighborhoods, they're fully 150 points higher than in the non-white areas of our city. It's the difference between prime and subprime. It's the difference between going to the bank or using your credit card and going to a payday lender. There's also a lot of data that shows that having at least as many banks or credit unions in a neighborhood as payday auto title lenders rent to own has a 30% boost in people's ability to build assets. So right now in Austin, we have a much higher concentration of banks and credit unions in the wealthier and more white areas of our city, a lower concentration in the non-white areas. And also I want to bring to home some payday and auto title lending data because Texas is particularly egregious. Over the past 6 years, from 2012 to 2016, or 5 years, I guess that would be, for 5 years of data, Texans paid $7.5 billion in fees to payday and auto title loan companies. for loans at 200 to 500% APR. And that's the equivalent of the full annual salary of 300,000 low-income Texans. And this is money that's being drained from our communities. And in addition to that, 186,000 families lost a car to an auto title lender. This was a car that was paid in full, and in Texas, a car is economic survival. So you think about how this is keeping our families in this cycle of having bad options. Because once you're stuck in a payday loan, what responsible lender will give you a loan? You can't, it's unaffordable to you. You're going to fail. So how do we start to break these down? Well, we have developed a city-based toolkit because we've really found that in our advocacy and work that we've had much more success at the community and the local level than we have in the legislature, or at this point, I think with the federal government as well. We're sort of in a place where the opportunities for improvements are limited. So I'm going to focus on 4 prongs that we've focused on in our work, and they're highlighted in our toolkit. And the first is working with cities to rein in market and policy abuses that the cities have the capacity to do. And we found that in Texas that there is a unique capacity that cities have with regard to payday and auto title lending. So Austin was the second city in Texas to adopt an ordinance that was reining in the practices of payday and auto title lenders, trying to put basic affordability parameters in place. And the good news is that it's had some pretty dramatic effects on our neighborhoods. So in 2012, when the ordinance was first adopted, there were 146 payday and auto title loan stores in Austin, and today there are 54. They're still concentrated in the non-white neighborhoods of our cities, but there are that many fewer of them. And what we found is that more of these stores does not mean lower prices or better products. More of these stores means more bad products. So that's a positive thing. Another really positive statistic we've seen since 2014 is that 1,300 fewer families have lost a car to an auto title loan in our city. So that's one of the policies that cities can adopt, and 44 cities have adopted. I'll go quickly through the others and can speak in more detail. The second is catalyzing beneficial products. Cities can play a role in that, both in financing them, and I don't think cities should shy away from putting up money, because a lot of capital was put into creating these divides. And I think a city-based fund to support community development financial institutions could reap great benefits and dividends for the cities. And just a quick example, an employer-based loan product that started in Texas and is hopefully going to be expanding to Austin soon, started with a $1 million infusion from the CDFI fund. They've now made 32,000 loans of over $25 million to people who would otherwise be going to a payday or auto title loan, and saved families $18 million. The third is decriminalizing poverty. And that happens both on the credit and on the fines and fees front that cities have control over. You know, the Tribune and NerdWallet did this amazing expose about how rent-to-own companies are sending people to jail when they default on their loans. We've seen that with payday lenders here in Texas, though it's illegal. And we're now seeing a reform of fines and fees so that indigency is taken into account. The next step for cities is also to look at suspending driver's licenses and making sure that they don't do that when the person who has an inability to pay is actually, you know, that's why they're not paying their fee. It's not malingering. It's not that they're not responsible. And so those are things that our cities can actually do. And the fourth is around financial empowerment programs. We have great resources in our communities. We need to get the word out so that when people need help, they have places to go. So.
You could join me in thanking our panelists. I have a couple of questions, and one was just presented to me, so I have a lot on my own, but please continue to send the questions up here. I was struck by how all of the sessions today have sort of come together. There's a theme here, right? So when we talked about the problems that Travis County is facing with the property tax and the fact that so much of it is driven by medical debt. And then we see that 50% of the debt and the debt collection in terms of defaulted debt is medical debt. So I want to talk a little bit about sort of how that debt affects credit scores. And it somewhat takes us back to I think the third slide for you, Garrett. Quote that I read recently: credit scores have become a metric of self-worth and the perceived key to success in this country. So I'm wondering, if you can sort of tee us off, or the other panelists, why are so many people's lives being ruined by low credit scores? You know, what can we do to help people improve their credit? Someone ties into, I think, Joyce's comments. And do we think credit scores should be used differently for different purposes? For credit, approving credit cards, for getting a mortgage loan, for getting a student loan? I mean, sort of, what are we to do with this whole monster known as credit scores?
Yeah, it's a fairly complex question, and we're relying on credit scores for a lot more these days. In fact, the Federal Reserve System did a study looking at people's credit scores and their likelihood to stay with a partner they've begun dating after 2 years. And if your credit scores, I believe it's over 50 points different than the person you're dating, you are less likely to remain in that relationship. And that's a reflection of, no one's saying that one causes the other, right? But it's a reflection of everything we're talking about, of the gentrification of our societies, of our communities, and even increasingly of our families, and the concentration of wealth and power and how that comes together. In the slide that's up now, we do apply credit scores differently in each one of these markets. The vast majority of our collective assets and debt that we keep and that our credit score is based on is in the housing market. It's the largest volume in which we use those dollars, and we heavily regulate that market. It's why 82% of the mortgage loan volume in Dallas County goes to those that have a prime credit score. But in Dallas County, our estimate is about 85% of people that are older than 18, only 85% of people have a credit score that could. That means 15% don't even have a credit score, which then limits your ability to access all of these services. And you don't have one because to get one, you have to have demonstrated an ability to pay back, to have income, to then get a credit card, to then build up the ability to then grow your credit. It's a bit like a resume. And we have lots of concerns about how credit scores have been used to deny your ability to rent, to look at if you should get a job or not, how available this information is, how limited it is, how it varies across the 3 agencies that rate our credit scores, and then what your recourse is if that agency gets that wrong. If your credit score is taken and somebody ruins that, how long it takes you to reclaim your credit and your ability to do that. So one highlight I'll note is on those first 2 lines, only 4% of residents in Dallas who have a deep subprime credit score also have a mortgage. And that's a huge reflection of the mortgage crisis that we just went through. And as a state, we more heavily regulate the mortgage industry, and so it's beneficial in that sense that we were not hit as hard by that, the crisis that we just went through in the Great Recession. But it also means fewer people have access to that ability to own a home. And that's the juxtaposition we do. In our student loan market, we do not apply those same restrictions. And you cannot get a good paying job in this country if you do not go to post-secondary, and we have to pay for post-secondary education, which is why 28% of the deep subprime market, for student loans, 28% have deep subprime scores, but because it's federally secured and because you cannot declare bankruptcy to discharge your student loan debt, they will garnish your wages, they will take it from your Social Security. There's ways to get that back. It's creating an interesting, challenging cycle here where we want to allow as much as possible people to get access to student loans. But then if they're not going to complete their education and they're not going to get an income to pay that back, there's now a very detrimental cycle that impacts all the other pieces we're talking about.
As it relates to the question concerning medical debt, we see a lot of medical debt collections on credit profiles with our clients. And for the most part, what we're hearing from the consumer is that they either thought the medical debt was going to be paid for by their insurance company, or it wasn't fully insured, or they had to go to emergency or something like that. Some life crisis happened. So it sits on the credit report. It's not addressed. The mortgage community, for the most part, doesn't hold the medical debt against being able to qualify for a mortgage loan, meaning it's not normally required to be repaid in order to get a mortgage loan. So you can actually get a mortgage loan without the requirement of paying the collection debt, medical collection debt. So that kind of doesn't hold them back from getting a mortgage loan. It's the traditional credit that holds a borrower back from getting a mortgage loan. So when we're dealing with collection overall, it just depends on what collections have to be repaid or required, which ones aren't. The focus is, what do you need to understand about how to use credit in order to be able to access the credit markets to protect yourself from having access to predatory or subprime products that are in the market. And so the goal is, if I have structured my credit based on education, then I empower myself to determine what my choices are about what I access. And I think, in my opinion, that the education starts with the education system. So we're dealing with the cause and not the effect. The cause is organizations that are not traditional lending institutions are able to do well in business because of ignorance. And if you empower someone through education, then the power is back in their hands, and they now have access to what they decide to get access to and what they decide that they won't access based on their level of education about what is APR, what is interest rates, how do I structure my credit, how do I use credit in order to raise scores, how much debt should I carry. What we're seeing also is that folks that have gone to college and have incurred a lot of student loan debts, they have now been able to achieve the higher income. They can't get access to mortgages because their debt to income ratios are too high, because now they're carrying a higher debt minimum payment because of the student loans. And prior to the collapse, student loan deferred was not counted as part of the inclusive in the debt to income ratio. Now, the minimum payment on student loans is now counted whether the student loan debt is deferred or not. So you can actually achieve the collegiate level education, which then acquires higher income, and still not be able to get into purchase housing, because now the debt from the student loan, along with other debt, has to be counted to determine how much you can afford to pay on a mortgage. So, it's really about education. I'm not saying that some loans aren't worse than others. I'm saying that if you don't know which loans are bad or good, and you don't know how to structure your credit, you're not in a position to make the proper decision. So we can say that the end result of the product and the product providers are bad. That's true or not true, but it doesn't matter how bad the end product is. What matters is how much education I have to have the power to make the right decisions about how I want to build and create my financial posterity. And that's what's lacking. Because when we teach the classes and we provide counseling, it's a lack of knowledge to determine what I should access. And if you don't have access to the education, then you're not making the decisions that will drive you in the right direction to create financial posterity. So I think it's a balance of both.
We actually have a couple of questions about financial education. I'm going to sort of pose a couple of different ways that we can think about financial education. So first I want to tell you sort of a little bit about a 2017 report that was recently publicized in the New York Times. There are 5 states, Texas is not one of them, right, that require high school students to take at least one semester, in some instances a full year, of a personal finance course in order to graduate. Utah leads the way, mandates both that there be a financial, a course on personal finance, and that the course specifically talk about the cost of college and student loans, to sort of follow up on the point that Joyce was just making. So my question to, I guess, the full panel, but specifically to Ann, I have a targeted one for you, and also for Joyce, is that when should financial literacy classes be taught? Not just when they come to you. I think that's too late. And if we say that they should be mandatory, what should be included? APR, interest rate, how to save, investing, sort of how should we think about, if we were going to propose this, either to sort of on the local level or on the state level, sort of what should we do about financial education?
Well, first I want to make the point that education does not replace good products. You cannot educate people out of if you have no options, you have no options. So I think that's a really important piece, and why having good standards for products is an essential component. So Texas actually does have financial education requirements in state law. We have a mandated financial education component. I think it's in the math curriculum for students through middle school, elementary school through middle school, and it's just recently gone into full effect. And there's an economics education course in high school that is required to include personal finance. So though we don't have a required personal finance class, we do have that. It's still, I think, too early in its implementation to see how it's played out. But there's a lot of research, and the CFPB has done some great research on school-based and working with younger children. I think it needs to be young children, and we need to continue it throughout the process. But the other thing, just like our general education, financial education doesn't start and stop at any particular point. And we always need to be thinking about key junctures when someone opens a bank account. What's the financial education that needs to happen there? And to ensure that the incentives are correct, that people have the option, do I opt in or opt out to overdraft? Well, ensure that when they're being presented with those options, that they're being presented with them in a way that doesn't bias them. Perhaps toward one decision, but I think that there's a responsibility through the whole system to offer it, but definitely young children seems to be a focus.
And we can talk about this after. I know quite a lot about the way financial education has been working over the last 5 years, because I happen to have a middle school student in AISD and a senior who's about to graduate. My poor senior has taken every single financial education course in his high school because mommy wants to know what they're teaching, right? And so there are lots of ways that they bring it up. It comes up in math, it comes up in government, but or economics, but it doesn't come up in terms of like hard information. So my question to you is, let's assume we're in a world where we're going to require financial information. Should we have like a consumer self-defense class? How to protect yourself from predatory loans, how to know when the good lender that shows up at your church, right, maybe not be working. And so should we have one, and what would that look like? Because it's not just APR. It's the subprime lending that is destroying and decimating communities. It's the don't go to that, because I loved the way you phrased it. The market is not, the fact that there was more competition with the payday lenders and the bad lenders did not make them better. It just meant that there were more of them to abuse people.
Right. Well, I'm sure there are people with much greater expertise than me in this topic. But my sense is we need to make it personal and tie it to personal goals. Because really our financial services and how we use finances, it's about how we achieve our personal goals in our life, about how we live in the neighborhood that we want to live in, how we have access to opportunities that we want to have access to, how we take that vacation that is really important to us. And so I think it needs to be taught in that realm. And there are a lot of nice programs that are like these little life, like you make decisions in your life and you go through and it shows you how it plays out, and oh, you bought the expensive car, look, now you can't make your rent, that teach people. But I think it's helpful because our finances are most relevant in the context of our aspirations.
So one piece I'd add to that, and I don't know if Raise Texas, if there's representatives in the room, but it's a statewide coalition that's advocating for asset building. I know Ann Bador's on their board. We at CPPP worked with Raise Texas to try to take exactly this approach. So we not only helped put in place the financial literacy curriculum from 3rd to 8th grade, but we're also working on the college savings account promise, which is not a new idea. But across the country, there's many cities, many other areas where they work to engage with low-income communities and provide a savings account for children. Right, so it's taking the dual approach and not only providing education about this stuff, but it's so abstract, especially when you're young. You don't know. We have the same thing with student debt. Students in college don't realize the severity of their loans. Well, certainly in elementary and middle school where you want to get these lessons learned. But if you have a savings account while you're in school and it's built into your curriculum, this is the promise of what we're working on. And places like Dallas and Houston are talking about this. There's a small pilot here in Austin. Scaling this has been a challenge across the country, but the promise of connecting those pieces and providing the education along with a positive new product and asset that you can use is something we're certainly looking at.
So sort of thinking about connecting pieces and putting groups together, one of the questions we received is that political change is often driven by unexpected or surprising alliances. So what surprising allies do you think might have the greatest potential to improve financial stability in the communities that you work with in either Austin or in the state of Texas?
I can give a little case study on that, and there's a little documentary that's made based on this case study of the payday lending ordinances that have now passed in 44 cities in Texas. It's called The Ordinance, and if you have 30 minutes to kill, I really recommend it. Just Google it on YouTube, and it tells the story of how this movement started in Texas. And what's unique about it is if you look at the 44 cities in Texas, they run the gamut from Austin, San Antonio, El Paso to Midland, Amarillo, Bryan College Station, Sulphur Springs and Longview. The latest Grand Prairie is the latest city to adopt this. It's across the political spectrum, across the geography. And it's been a combination of the faith community with the nonprofit community with elements of the financial services community coming together. And that's been the partnership. And what's so interesting is at the state level, that partnership has not been strong enough to move anything because of the power of the lobby. But at the local level, where I think we got the first panel talking about the mayor of El Paso and how he sounded like a Democrat. But at the local level, these are much more direct issues, and the economic impact is much stronger. But we found that combination has been very powerful, and each of those different groups have different incentives and motivations of why they're committed to it, and they all come together, and it's caused a sea change.
I believe those alliances that you're mentioning are paramount. I've gone into a couple of high schools to try to provide financial literacy education, and the students are basically not interested because they basically don't see the relevance. They have a high consumption mindset because they are not getting those practices and morals in the home. And so, and then the teachers don't have the time to implement the on-the-ground education level that from the schools that I've gone to because they are so busy trying to meet the education requirements for these exams. So, and then they don't have the formal education to implement because they may not be doing well themselves in credit, and so they don't have the formal education to teach it on the ground. So I think as far as the education and what needs to be taught, it is the APR, it is the interest rates, it is the different type of mortgage products, the lending products, the different type of savings, how savings works, interest rates, rule of 72, rule of 50-25. Understanding these concepts and then not just having it a state mandate, but how do you really make it part of the education where the educator is educated, the trainer for the teacher, and then making that part of a requirement for graduation to learn those principles so that when students get into college, they're not being tempted to accept credit cards, not knowing, because they don't have cash. So they're more susceptible to taking credit cards and filling out credit card applications because they're trying to replace not having any cash. So I think that these alliances that you mentioned are, my church I know is implementing financial education, and we're partnering with a couple of other groups, and I think that it is going to have to start on a community level. Definitely, it will definitely have to be a community level because it's not, even though there's a state mandate, it's not having the level of impact that it needs to have.
And when you say the state mandate to have a piece that's
A piece, yeah, right, the education. So similar to what your child is getting in school, it's not dealing with protecting from predatory activity. It's not dealing with the type of education that you should have about personal finances to protect you from making bad decisions.
And I will add, those courses are offered because my child is being forced to take all of them,
right?
But they're not mandated.
They're not mandated, right? Exactly.
Yeah,
and
so he came home talking to me about. There was one of those commercials, Cash Advance, Cash America, or something. He goes, oh, that's not such a bad thing. And of course, my head exploded.
Yeah.
So now he knows why. But until we say that financial education is as important as passing the algebra star, we can imagine why public school teachers may have a slightly different incentive in terms of what they're teaching.
And on the flip side of the coin, if the traditional financial institutions aren't educating about non-sufficient fund fees and not putting a cap on how many NSF fees a consumer can incur, then that is a perpetual problem as well, because then if you look at, that's a short-term loan. An NSF fee is a short-term loan, so it ends up being an APR that could blow the APR from a payday lender out of the water. And what we see with some of our clients is that there's a perpetual activity in NSF, and they think that that's a rescue to allow the check to clear, as opposed to how that's being consequenced on the back end, both on the cost of the NSF fee and how it consequences them or prohibits them from moving forward in the mortgage lending environment.
Yeah, I'll try to take a quick step back. If I ask the room how many of us either have student loans ourselves, have co-signed one, or have one in our family, almost every hand in this room would go up. Right? And it's the highest level it's ever been. And 1 out of 4 people with a student loan are struggling to pay back that loan. Right? So this isn't just the coalition of those who are in concentrated poverty or lower income neighborhoods. These questions are now reaching all of us because of the degree to which we use this. Another example is medical debt. How many have heard the term surprise billing? This is an area that we've helped push and pioneer here doing research in Texas. It's getting some national attention. Vox Media and others are now looking at what happens to all of us when we go to our emergency rooms. I'd venture to guess most of us don't know, if I were to go to the emergency room now or you to go to your local emergency room, what's covered and what's not if that doctor, who you don't know who's going to be there, is out of your network. And you can go home with huge bills because your insurance company doesn't cover that particular doctor. And now you have to pay that debt. Well, now surprise billing and medical debt, which again is half of the collections in the country, are affecting all of us across the income spectrum. And so we're partnering, like on many of these issues in Dallas, with the group Faith in Texas. It's those that have congregations across the region from a faith perspective who are asking this question: what does a moral economy look like? How do we address these issues together? How do we engage with the people in our different groups? And they've gone to their congregations to ask. Debt and credit is a huge issue. Let's look at a lot of these questions on the fines and fees that city charges, on all these issues on affordability. And medical debt was the question that they kept hearing back and back, that's what's affecting us. That's what we want to work with. So we're working with them in Dallas County, with the public and private hospitals in that area, to look at the policies that are in place. What happens if I take the ambulance, which is contracted out by one of my hospitals? Am I going to pay for that? Are they going to pay for that? Are those charges higher? If I don't have insurance, what happens there? It's a big, complicated place that groups like ours can start to put a good spotlight on, to say our public hospitals are probably doing a good job. What about our privates and others? We need to tighten and clean those areas up. And the coalitions interested in this are getting a whole lot broader.
We received a question about how does credit, debt, and lack of financial education affect household formation and stability? And I'll sort of throw out a couple of things that we've probably seen in the newspapers. The fact that, and this is tying with Garrett's last point, student loans, right? The fact that there are so many, not just students, but also parents who are struggling with student loans has caused young people, people are getting married at an older age. They are not forming households. It's had and continues to have an effect on the homeownership rates. I'm somewhat conflicted about how I feel about homeownership. For those of you that have ever heard me speak, you know sort of where I'm coming from with that. But it is certainly affecting the homeownership rate. So any other things that you all have seen in terms of what credit and debt is doing to the way we live now as human beings?
Well, it definitely affects people's housing options because you can't rent an apartment if you don't have good credit. And so I think that that's one of the problems with how credit scores have been so integrated into so many systems, that they're really creating a lot of barriers for people. You know, the solutions are really bigger policy solutions. You know, we need to change the law in terms of how those are used, and I think that's a very heavy pull right now. But it absolutely affects what neighborhoods people can live in, what quality of housing people can access, and I think that's a pretty major impact.
This actually ties into that. I'd still like to hear another question. You know, what do landlords gain by reporting eviction debt to credit bureaus? Because obviously it affects what you can do in the rest of your life.
Right. I mean, I think they gain the same thing that any other creditor gains from reporting data. Then that data is collected so that other landlords, so they will have access to it when someone comes to rent, and it's a way that they try to create systems that allow them to select people they think will pay. I think one of the problems is that there are not a few instances where people may be evicted unjustly, but because individuals have limited access to counsel in those scenarios, they often get rolled over and their rights aren't upheld. And so they'll perhaps be wrongfully evicted, but then now there's this judgment against them, and it has all those rippling effects. I think it just ties into the interconnectedness of so many areas that we all work in.
You know, the credit issue is an issue. You know, everybody's using credit, but what's also affecting access to options on housing is affordability. That's a major issue. Landlords are not setting rent rates relevant to the income levels in the area, the Austin area. So even if you had great credit, if your income couldn't afford to get access to a decent, affordable rental unit, then the credit really isn't the issue. It's the affordability. So it's kind of a two-pronged situation. It's not just the credit eligibility, but it's also the access to affordability. So we still have a problem. If we resolve one, we still have to deal with the other issue. So just wanted to bring that to bear.
I'll just quickly add the dimension of race and ethnicity and intergenerational wealth. The racial divide is affected hugely by the things we're talking about here. So the types of families that get to benefit from access to credit and those that don't. If the average white family, a white household in our country has $1, then the average black family has a dime in wealth. The average Hispanic family has a dime and 2 more pennies for every $1 that the average white household has. Right? Your access to everything we're talking about is not making that divide less, it's growing that divide. Mm-hmm. And that divide is getting worse as individuals get older because families accrue more wealth and assets as you get older in life, but that's not happening at the same rate. So the divide gets larger over time and as we get older, and we're headed in the wrong direction. So it leaves lots of questions for us to ask.
But I also think with that point, the level of education about how money works determines the power of choice. So if you understood about how money works, if you don't understand how interest rates work, and that's not really part of your spectrum, your wheelhouse of education, then you're not using money for the purposes of building wealth, you're using money for consumption. If you understood interest rates, you understood the rule of 72, you understood compounding interest, then you might rethink your use with money. And that's what we see during our counseling program, is that when we educate our clients about not just sources of funds, but uses of funds and how that plays into building wealth, it's like, I wish I had known that. I wish I had known that if I put money in a money market versus a savings, I had a greater yield. I have a greater opportunity to yield a greater level of return. So people don't make the connection, and it's not because the services are not accessible as much as it is they don't have the relevance of those services to make that connection.
This sort of takes us on a somewhat broader level with how consumers get information about the financial services. So the question is, generally, I mean, you all have a wealth of knowledge and your organizations do wonderful things. So this question asks, people generally have little or no knowledge of resources like CDCs, HUD-approved housing counselors, and CDFIs.
Right.
Great sources of information on credit, home buying, et cetera. And instead, most people rely on unreliable, predatory resources. We Google things, and you can imagine which companies have made sure that their stuff hits the top of the list. So how do we advertise and publicize good resources for financial education, good resources as opposed to the bad ones?
Well, I know that the public sites that provide down payment assistance, like Texas Department of Housing and Community Affairs, Texas State Affordable Housing Corporation, City of Austin, they do advertise the partnerships with nonprofit organizations, CDCs, for homebuyer education. Organizations like ours don't have the marketing revenues to make it known who we are and what we do. Subsequently, the sources that provide grant funding don't provide enough. So the value is that we believe that education should be a part of one's approach before making purchases or spending money or being a consumer in the debt market. But the investment on the way of the support of an organization that provides that level of education is not there. So there is a divide there too, accessing dollars for marketing purposes versus because most people don't even know that frameworks exist unless they were told about it from a friend, a coworker, someone who attended. We don't have the marketing dollars. So if we had the marketing dollars, then the awareness would be out there. And I would say that that's probably the space for most smaller nonprofit organizations, is that they don't have the dollars to get the word out. So, yeah.
So I'd add that, I mean, we went through this great recession, and coming out of that, we created something called the Consumer Financial Protection Bureau nationally to do these issues, to look out for individuals and advocates. And Ann Bador leads the Texas Fair Lending Alliance, which is really the point of us here in the state trying to tell at the federal level why that's important, why we need that to be as strong as possible, because it's under attack and it's being diminished. We have an equivalent here in Texas. We have a Commission of Finance. There's an Office of Consumer Credit Commissioner. And it's under sunset review. Those of you who know the state policy levers, every 10 years, every agency has to go under something called sunset review. The idea being, if that agency is not doing good work, we can sunset it and it can stop doing its work. That rarely happens, but it can. But it creates an opportunity to look at all of the things that we're doing in state government and provides a legislative vehicle to say, here are some opportunities to do more of looking at payday lenders, to do more of looking at consumer protections, to do more of the sorts of things we're talking about. There will be a report that will come out from the Sunset Commission on our state equivalent in April from our Sunset Review Board with recommendations and ideas. They'll make recommendations to the legislature in the fall. In 2019, when the legislature convenes, there will be at least one, if not a series of bills looking at these issues at the state level. It'll be important to be aware and to think about these and to make your voice heard where you see important corollaries in your work, your life and work.
We have either no time or we have 3 minutes, and so this will be our last question, if you all can sort of give the takeaway, right? So people that are listening to us, what's the greatest takeaway? What's the ability of financial services to impact economic resiliency in cities or on a regional scale? So all of these things that we think people at the individual should have on the ground, sort of how does that help regions, help cities?
I think it has tremendous capacity to help.
Absolutely.
Our financial services system is where we can save money to help us weather financial hardships. It's where we can access products when we need them that are fair products. It's the system that sustains the economic vitality of our families and our community, which is why there's such a need to have deliberate policies that crack that wall and that give families that are on the wrong side of that wall, that start to open up access to a financial service system that actually builds communities rather than one that sucks wealth away. But I mean, and it's why it's sad to see what's happening to the CFPB right now at the federal level, where because it had come out in its initial phase as really something that was starting to equalize and create the kind of accountability that will hopefully be in the long run a win-win for the communities, for the financial institutions, for the financial service providers. So we're losing, well, we're not losing anything, but it's changing. So I think that puts more pressure on our local communities to really stand up and say, okay, what's our vision? What do we need for our communities, and how do we make that happen? And we absolutely have the capacity to do that. Do we have the will?
And I would say we're losing. Anytime you have an executive director of an agency that requests zero in funding, you get a pretty good sense of how that director values the agency.
I agree with all of what's being said. I just don't know how to connect the mainstream on the ground folks to this high level access to services and education and information and what's available. Most consumers don't even know what the Consumer Financial Protection Bureau is. It's a great resource. I think it's something that needs to continue to exist, but how do we get the average person aware of these resources so they know that these resources are available and they know what to look for and how to access them? I think that's where the disconnect is. How to take that high-level information and bring it to the average person for utilization and implementation.
The last thing I'll say is I do a lot of work in our workforce space and education space, and there the conversation is about how robots are coming to eat us. They're going to take all our jobs. We're going to be left with that. And we all have to reskill and upskill and understand a whole different complexity for the jobs of the future. And there's a divide growing there. In this space, it's the same thing. Financial literacy is not something we hope to have, or one day I want to have a mortgage. It's an actual literacy thing you need to have to function in the world. Our world is getting so complex, and there's the same divide. If we don't know how to operate with, I mean, very few of us carry coins and alone cash anymore. We're all carrying cards that have chips and data. Very few of us understand our mortgage rates and our API. Like, even us up here, like, I'm not exactly sure I know where all my retirement dollars are right now. That's not acceptable. They're not high enough, right? And I bet if many of us were honest, we don't know answers to those questions. And we're the ones that have some freedom and flexibility at night to do that because we're not working 2 jobs and we're not struggling with all the other things we've talked about. So financial literacy is the literacy of our time, just like
Absolutely.
getting new jobs is going to be all of our jobs as well.
If you would, join me in thanking our panel.